Is it on the rocks or soon to continue? Let's ask Anastasia Amoroso, Chief Investment Strategist at iCapital. And I'll ask to beg your pardon if I have to interrupt you and show you those pictures of the former president leaving the courthouse just a few blocks from where we're located here. But in the meantime, the state of the market to you is what?
Well, I think it's some consolidation after a stellar rally that we had last week. I mean, the S&P was up 3.4%. Tech is up well over 20%. So we've really moved a long ways in a short period of time. But we got a little bit weak economic data. You know, Scott, you mentioned job openings. We also got the manufacturing report that disappointed somewhat. And then the GDP was tracking 3.2%. Now it's tracking 1.7%. So, you know, that is kind of the cause for consolidation. But that still doesn't deter me from saying that I think we can have a more positive tone to April, because if you look at the broader picture, we sort of have the recipe for a soft landing, which is inflation expectations are coming down, and broadly speaking, economic data is surprising to the upside. So that actually still supports the resilient stock market.
I just wonder, if we had the ingredients for a soft landing, whether we threw something sort of rancid in the stew, if you will, and that being what happened with the banks,
right,
and now fresh concerns about what may happen with credit from here.
Yeah, that's right. So it's an interesting part of the business cycle, because I think we are just about to be done with tightening. And if you think about how stocks perform, they don't perform well during the tightening phase. But what happens after tightening is sort of this relief that is to say, OK, we may be done with the rate increases. That's behind us, but the economy is not weak enough. And I think that's where we're sort of headed. And then eventually, Scott, I think the second order effects do come to roost, and that's what eventually causes a recession. So I don't think we're in that scenario now. And the banking turmoil for now, to me, is contained, if not all the issues have been fully solved there.
I've got, seasonality, as you mentioned, April's good. Economic data, as we learned yet again today, not so much. Which sort of wins the day if that scenario continues, right? You know that April is one of the best months traditionally of the year. But if the data continues to come in showing weakness, that's going to rule the day, isn't it?
Yeah, but think about the starting point for the data. We were coming into the year thinking that we're going to get 0% GDP growth. And instead, even if it's 1.7%, guess what? That's still better than the call for the recession or growth or no growth that we've had. So I think what's likely to happen, companies will start reporting their earnings just next week. And the typical earnings downgrade is about 3%, kind of quarter preceding to the reporting season. Mm-hmm. Now we've downgraded those estimates by 6%. And if you looked at the negative pre-announcements, they've been much higher than in prior quarters as well. So, Scott, I think the bar has been reset pretty significantly lower. And even if we don't get the 3% GDP, 1.7 might be enough for the positive surprises to the earnings picture.
I am wondering whether earnings are going to be a help because they don't come in as bad as feared, or a hindrance because it's a reminder of just where we're heading, especially when you get the commentary from the companies, not the numbers themselves, but what all of these CEOs, men and women, have to say about the trajectory for the economy.
But I would think they're more encouraged today than they were in the beginning of the year. And once again, because economic resilience actually surprised.
You think encouraged?
I think so. They've sort of reduced the estimates so much. I mean, if you look at semiconductors, they've cut down a lot. If you look at tech companies, if you look at the average software company, for example, they significantly revised down their guidance. And now you have a scenario where inflation is easing. The Fed is sort of being forced to pause. And a lot of them have probably baked in the continuation of the hiking cycle. And then the economy, this consumer is stomaching 5% rate. So I actually think they might be a little bit less pessimistic than they were sounding at the beginning of the year.
I don't know. I'm looking at one of the most prominent CEOs in America today, and his letter, his annual letter, Jamie Dimon. As I write this letter, the current crisis is not over. And even when it is behind us, there will be repercussions from it for years to come. Any crisis that damages Americans' trust in their banks damages all banks. I mean, he goes on and on about thinking that we're not out of the woods quite yet, even though he'd be the first to say, and he does in the letter, that it's not 2008 all over again. But nonetheless, it doesn't have to be potentially bad.
Well, he's absolutely right to highlight the ongoing concerns for the banking sector. The reality is if you're a bank and you're competing with 5% Fed funds rate, you have to pay up for those deposits. So what's going to happen is the cost of funds for regional banks is going to have to go up if they are to keep the deposits there. And at the same time, I think he highlights in the letter the held to maturity issue. If all of a sudden deposits go out and you have to move those held to maturity securities to available for sale, you take a markdown on those assets. So that issue has not been solved yet. And Scott, then the next test for the banking sector is going to be commercial real estate. I do think the defaults there are yet to come. And so he's right to kind of highlight that as one of the issues that's not been solved.
So let's add Nicole to the conversation. She's sitting right next to you, of course, Nicole Webb of Wealth Enhancement Group. The other issue, welcome, I wanted to get into was the offsides nature of how the market has caught people this year. Technology has been the big winner. Up until the last couple of days, energy has been the big loser, certainly far from what people expected might be the case as we came into the year.